You're listening to the Bare Metal Cyber Prepcast, created to help you succeed in your educational journey. Learn more at baremetalcyber.com, where additional prepcasts, books, and training materials await. Let's get started. Mergers, acquisitions, and divestitures are among the most complex events in the corporate lifecycle, bringing with them a host of privacy considerations that extend from the first due diligence request through post-close integration or separation. These transactions often involve vast transfers of personal and sensitive information, consumer records, employee data, and sometimes regulated categories like health or financial details. The challenge for organizations is to manage these transfers in compliance with privacy laws, contractual obligations, and consumer expectations. For learners, the lesson is that privacy cannot be treated as an afterthought in corporate deals. It influences valuation, contractual protections, regulatory risk, and ultimately the trust of employees and customers. A misstep in handling data during a transaction can result in regulatory scrutiny, reputational harm, or even a collapse in deal value, making privacy diligence as critical as financial or operational reviews. Pre-deal privacy due diligence typically begins with broad document requests designed to assess an organization's privacy posture. Buyers seek privacy policies, notices, internal governance documents, compliance assessments, and summaries of any incidents or enforcement actions. They also request details on vendor management practices, international transfers, and data inventories. For learners, these requests reveal how privacy compliance is viewed as a core operational risk. Just as buyers review financial statements to assess stability, they review privacy frameworks to gauge exposure. The presence of robust policies and evidence of adherence often enhances confidence, while gaps or outdated practices can raise red flags requiring remediation or price adjustments. A cornerstone of diligence is data inventory and mapping. Buyers need to understand exactly what categories of personal and sensitive information are collected, where they are stored, and how they flow across systems and jurisdictions. This mapping identifies key compliance issues, such as cross-border transfers or special categories of data. For learners, data inventories highlight how privacy is grounded in knowledge. Without visibility into what data exists and where it resides, neither compliance nor integration can succeed. Inventory and mapping are thus both a diligence tool and a strategic resource for planning future data governance. Consent and contractual use restrictions can complicate post-close processing. Some consumer consents are tied to specific brands, products, or purposes, limiting the ability to repurpose data after a merger. Vendor contracts and data processing agreements may contain restrictions on transfers or require notice of change of control. For learners, this underscores how privacy obligations are embedded in legal relationships. Data cannot be assumed to transfer freely. Contractual and consent-based constraints must be respected. Failing to account for these restrictions can delay integration, limit synergies, or expose organizations to claims of unauthorized processing. Historic incidents, investigations, or litigation tied to privacy practices can materially impact deal valuation. A company with a history of data breaches, consent decree obligations, or unresolved regulatory inquiries carries risks that must be factored into negotiations. Buyers may demand indemnities, escrow holdbacks, or purchase price reductions to account for potential liabilities. For learners, this reveals how privacy history shapes corporate reputation and financial exposure. A strong security record adds value, while a troubled one imposes costs. Diligence in this area helps prevent buyers from inheriting costly surprises after closing. The regulatory posture of the target company is another focal point. Buyers examine whether the organization is subject to ongoing orders, remediation plans, or compliance monitors. They also review correspondence with regulators, enforcement actions, and internal audit findings. For learners, this illustrates how privacy regulation is an active, ongoing dialogue between companies and authorities. A company that has built a cooperative relationship and demonstrated good faith compliance is viewed more favorably than one that resists oversight or fails to implement corrective measures. Regulatory posture signals cultural attitudes toward compliance as much as technical adherence to rules. Vendor contracts and data processing agreements are scrutinized during diligence. Buyers assess audit rights, sub-processor approvals, and termination clauses to ensure continuity of operations. Contracts with weak security or privacy obligations may expose the buyer to risks if not updated post-close. For learners, vendor contract review highlights the interconnected nature of privacy compliance. No company stands alone. Its ecosystem of vendors can amplify or mitigate risks. Reviewing these agreements provides insight into how seriously the target manages downstream obligations and safeguards sensitive data entrusted to third parties. International transfers and localization requirements are also examined. Many jurisdictions restrict transfers of personal data to other countries, requiring mechanisms like standard contractual clauses or binding corporate rules. Buyers must confirm that these mechanisms are in place and evaluate whether localization laws require certain data to remain within national borders. For learners, this area demonstrates the global dimension of corporate transactions. A deal involving multinational operations must account for a patchwork of international privacy obligations, with non-compliance threatening both regulatory action and operational continuity. Employee, applicant, and human resources data are central to many transactions, especially when large workforces are involved. This data includes sensitive details such as payroll, health information, and performance records. Buyers must ensure that transfers comply with labor laws, privacy requirements, and confidentiality expectations. For learners, this highlights how privacy is not only about consumers, but also about internal stakeholders. Employees are directly affected by how their personal information is managed during a transition, and mishandling can erode trust and morale at a critical moment. Special category datasets, such as health, financial, or biometric information, receive heightened attention. These categories carry stricter legal protections and higher risk if misused. For example, biometric data collected for authentication must be handled with specific consent and security safeguards, while health data may be subject to HIPAA or similar regulations. For learners, this reinforces the idea that not all data is created equal. Sensitive categories magnify compliance obligations and risks, demanding closer scrutiny and stricter controls during diligence and integration. Relationships with data brokers, edtech vendors, and analytics firms raise unique implications. If a target relies heavily on data sales or behavioral advertising, buyers must assess compliance with evolving regulations like the California Consumer Privacy Act or GDPR restrictions on profiling. For learners, this area illustrates how business models themselves create privacy risks. Companies built on monetizing data may carry structural liabilities if those practices conflict with consumer expectations or regulatory trends. Diligence in this space examines not just contracts but the sustainability of entire revenue streams. Records retention schedules and legal hold obligations also affect data migration planning. Buyers must confirm whether records are being retained too long, creating unnecessary risks, or whether they are aligned with legal obligations. Legal holds may require specific datasets to remain untouched, complicating integration. For learners, retention demonstrates how privacy intersects with information governance. Too much retention increases exposure. Too little jeopardizes compliance. Diligence helps balance these competing risks while planning for migration efficiency. Security control maturity is a key diligence item. Buyers evaluate whether the target maintains certifications like ISO 27001, conducts penetration tests, and implements regular vulnerability management. Past penetration test reports and remediation practices provide insight into maturity and culture. For learners, security evaluation demonstrates that privacy is inseparable from security. Weaknesses in controls not only endanger data, but also undermine trust and compliance. Assessing maturity ensures buyers understand the resilience of the systems they are acquiring. Clean room approaches may be used during diligence to minimize privacy risks. In this model, sensitive data is reviewed in isolated environments with strict access controls, ensuring that only essential information is shared with buyers. This allows diligence to proceed without unnecessary exposure of consumer or employee details. For learners, clean rooms exemplify the principle of minimization in practice. They provide a way to balance the legitimate needs of deal evaluation with the obligation to limit exposure of personal data, demonstrating how compliance and business needs can align. Finally, risk quantification ties all diligence findings together. Buyers may adjust purchase prices, establish escrow accounts, or negotiate indemnities based on identified privacy and security risks. Quantifying these issues translates qualitative concerns into financial terms, enabling informed negotiations. For learners, this illustrates how privacy risks are not abstract, they directly influence deal economics. By quantifying risks, organizations integrate privacy into the heart of financial decision-making, ensuring it is valued alongside revenue, assets, and liabilities. For more cyber-related content and books, please check out cyberauthor.me. Also, there are other prepcasts on cybersecurity and more at baremetalcyber.com. Change of control clauses are a critical consideration in transactions involving personal data. Many privacy policies, contracts, and consumer agreements contain provisions that limit or condition the transfer of data when ownership changes. Some require notice to consumers, while others offer opt-out rights if data is shared with a successor entity. For learners, these clauses highlight how consumer trust is embedded into legal frameworks. Ignoring them can create compliance gaps or even render certain datasets unusable post-close. Properly handling change of control provisions ensures both legal compliance and the preservation of customer goodwill during transitional periods. Transitional Services Agreements, or TSAs, are often used to maintain business continuity while systems are separated or integrated. These agreements may involve interim access to data, shared infrastructure, or joint use of applications. Privacy risks arise if access is not properly segregated or logged, exposing personal data to unnecessary parties. For learners, TSAs demonstrate how temporary arrangements can carry lasting consequences if not carefully managed. Strong segregation, access controls, and audit logging are essential to ensure that personal data remains protected during these transitional phases. Day 1 controls focus on immediate measures implemented at closing. These include provisioning access for authorized personnel, applying least privilege principles, and monitoring activity closely. Without strong Day 1 controls, organizations risk data leaks or misuse during the chaotic early days of integration. For learners, this illustrates how privacy and security must be prioritized from the outset. Even before long-term integration plans are executed, foundational safeguards must be in place to protect sensitive information from exposure. Policy harmonization and privacy notice updates are central to post-close integration. Merging organizations often have different privacy practices, and aligning them is critical for legal compliance and consumer clarity. Updated notices must explain how personal data will be used under the new ownership and give individuals an opportunity to exercise applicable rights. For learners, this emphasizes the communication dimension of privacy. Policy harmonization is not only about internal governance but also about ensuring that consumers understand and trust how their information will be handled going forward. Data migration planning requires careful reconciliation and verified deletion of redundant or outdated copies. Moving datasets between systems carries risks of corruption, misalignment, or unauthorized access. Verified deletion ensures that old systems do not retain unnecessary or duplicative personal data. For learners, this highlights the importance of discipline in data lifecycle management. Migration is not simply a technical exercise, but a compliance obligation that requires accuracy, minimization, and respect for legal retention rules. Vendor novation and sub-processor approvals are also necessary during transactions. Existing contracts with third-party vendors may need to be reassigned to the acquiring entity, and new processing instructions must be issued. Sub-processor relationships may require notification or approval under regulatory frameworks such as GDPR. For learners, this illustrates the continuity risks embedded in vendor ecosystems. Contracts must be reviewed, updated, and monitored to ensure that privacy obligations flow seamlessly to third parties after ownership changes. Cross-border transfers often require updates after a merger or acquisition. Data may begin to flow along new routes between jurisdictions, triggering the need for transfer impact assessments, standard contractual clauses, or other mechanisms. For learners, this demonstrates how corporate geography affects privacy compliance. A merger that connects entities across regions may inadvertently create international data transfer risks, requiring proactive attention to ensure compliance with global regulations. Carve-out transactions present unique challenges. When a business unit is divested, it must be separated from the parent organization's systems and governance. This requires establishing new privacy frameworks, appointing officers, and creating independent policies for the carved-out entity. For learners, carve-outs show how divestitures can be as complex as acquisitions. Separation requires building privacy operations from the ground up, ensuring that the new entity can operate independently without compromising data protection standards. Employee data transitions require careful handling. Workforce information includes highly sensitive details such as payroll records, performance reviews, and health benefits. Transferring this data must align with confidentiality obligations, labor laws, and retention rules. For learners, this illustrates how employees are stakeholders in corporate transactions. Their trust in leadership depends in part on how their personal data is managed, making employee privacy a vital element of responsible integration or separation. Post-close integration requires tracking progress through metrics, audits, and remediation plans. Institutions must monitor how privacy controls are being aligned, whether deficiencies are being resolved, and how risks are trending. For learners, integration monitoring highlights the importance of accountability. Closing a deal is only the beginning. The real test is whether privacy risks are effectively addressed in the months and years that follow. Metrics provide visibility and drive continuous improvement during this process. Incident response coordination is particularly important during transitional periods. Two organizations with separate playbooks may struggle to respond effectively if an incident occurs before integration is complete. Shared playbooks and aligned processes ensure that breaches are detected, reported, and contained in a unified manner. For learners, this underscores the need for preparedness. Privacy risks often spike during transitions, making coordinated incident response a cornerstone of resilience. Board and executive reporting ensures that privacy integration milestones and risks are visible at the highest levels of governance. Leadership must receive updates on progress, challenges, and emerging issues to allocate resources and drive accountability. For learners, this illustrates how privacy is no longer a purely operational matter. It is a governance priority, integrated into strategic oversight and directly tied to corporate reputation and deal success. Consumer communication planning rounds out the integration process. Customers must be informed about changes to ownership, policies, and rights in a clear and trustworthy way. Confusing or opaque communication can undermine confidence at a sensitive time. For learners, this emphasizes the reputational stakes of privacy. Transparent, empathetic communication not only satisfies legal requirements, but also preserves loyalty and brand trust during disruptive events. Finally, lessons learned from one transaction should be captured to refine future diligence checklists and integration playbooks. Organizations that evaluate what worked, what failed, and what could be improved position themselves for smoother future deals. For learners, this reflects the maturity of privacy governance. Continuous learning and improvement ensure that each transaction strengthens the organization's overall capacity to manage privacy risks, making it more resilient and prepared for future challenges. In conclusion, privacy in corporate transactions requires attention across the life cycle, from diligence and contractual controls to integration, migration, and communication. Early diligence prevents costly surprises, precise contracts maintain accountability, and disciplined migration and governance ensure compliance and trust. For learners, the enduring lesson is that privacy is inseparable from corporate strategy. Effective handling of data during mergers, acquisitions, and divestitures preserves value, ensures compliance, and strengthens the trust that underpins long-term business success. Thanks for tuning in to the Bare Metal Cyber Prepcast, your trusted source for cybersecurity news and insights. Remember to subscribe at baremetalcyber.com so you never miss an update. And visit cyberauthor.me for best-selling cybersecurity books that equip you with expert knowledge. Until next time, stay secure and stay vigilant.